Dividend growth investing. Subscriber questions. I'm going to answer more subscriber questions today, 3 to be exact. I've answered 17 subscriber questions so far as part of the celebration of 25,000 subscribers. I am so blessed here on PPC. Ian, thank you for subscribing. It means the world to me. 3 more today to get us up to 20, and then I'll only have 5 to go. But don't worry, as part of my 30,000 subscriber celebration, which is right around the corner, I'll be answering 30 more questions. So let's jump into today's dividend investing questions. All right, everyone. So I have my laptop again. In terms of full disclosure, I am long Apple, ticker symbol AAPL. Wrote down 3 questions. There's going to be 3 today instead of 5 because these are longer questions. And the first one is a really good one. So let's get started. This one came from Twitter, by the way. I'll link in the description below to my Twitter and Instagram. If you're not following me there, please do. I have a lot of cool stuff coming there that you won't find anywhere else. And I'm sharing different things on Twitter, on Instagram, on YouTube, and so you'll want to check out all of them. Anyways, on Twitter, hello Ian, I love your channel. It has made me see dividend investing in a whole new perspective. Thank you, that really means the world to me. As a dividend investor, why would someone invest in stocks like Disney, ticker symbol DIS, that have a lower yield than inflation without taking into account its growth, just its pure dividend? Okay, so good question. I recently did a video about Disney. I'll link in the description below. Both of my kids own Disney in terms of full disclosure. I personally don't own Disney in my personal portfolio, but both of my kids do in their custodial accounts. And a lot of the reason behind that ties into today's question from this subscriber. So really, really good question. So before we get into the question, I just want to share some background. Right now, Disney is at $132.79 per share. Their dividend, it's 88 cents. It's paid twice per year, not quarterly. It's actually paid twice per year. And if I take that, multiply by 2, divide by the price per share, the starting yield is a 1.33%. So no one, well, unless you have a lot of money, no one is paying their living expenses off of a 1.33% yield. So if someone needs to retire tomorrow, they're likely not going to want to buy Disney stock if they plan on living off of dividends. And so also worth noting, their dividend, it has doubled when I compare 2013 versus 18. So this is a very quick growing dividend. And so the fact of the matter is Disney stock. This is a company that I call a dividend growth stock, hence the title actually of today's video, Dividend Growth Investing. The growth comes in 2 ways. There's growth in the dividend, and so the dividend doubled 2013 versus 18, doubled, a lot of growth in the dividend, but the company is growing too. The company is growing quickly, hence the growth. So the growth really touches this company 2 different ways. And so why would someone buy Disney stock? The reason someone would buy Disney stock is they want to live off of dividends, but they don't need to live off of dividends tomorrow. They're thinking maybe 10 years out, 20 years out, 30 years out, or even more. Their investment time horizon is very, very far into the future. There's a reason I don't own Disney in my personal stock account, that it's in my kids' accounts. They have more time on their hands than I do. And so my kids, they're not going to be living off of dividends for quite some time, but I want to pay our family's expenses off of dividends sooner than later. And so for me, I'll just take a practical example. The yield right now is at 1.33%. Let's say the dividend doubles 5 years out. My yield on cost will go to a 2.66. Let's say it doubles again 5 years after that, so 10 years out. My yield on cost will become a 5.32%. 5.32%, quite frankly, after 10 years is not that bad. That's actually pretty reasonable. But a lot of the stocks that I have, my yield on cost after 10 years of holding them is actually going to be higher than that. And I've shared a lot of examples on this channel, so I'm not going to go through them now. But a lot of the time, I can totally beat 5.32 after 10 years. 5.32 would be on the way, way lower side in terms of a yield on cost. But looking 50 years out, for example, the opportunity to have a high yield on cost of Disney, it's potentially higher than a lot of other companies, a lot of other investments. And so why would someone buy Disney? It all comes down to time horizon. Typically, what I've found as a dividend investor, for a time horizon of further out, it's oftentimes more advantageous to buy lower starting yield, higher growth stocks, like dividend growth stocks that are growing the dividend and growing the company. Companies like Disney. For people like myself who want to retire sooner than later, I mean, I'm going to probably start paying for bills with dividends within the next 10 years. Maybe not all of the bills, but bills. And certainly within the next 20 years, I want to pay all of my bills, or at least most of my bills, with dividends. And so because my horizon is a little sooner, and honestly, I want flexibility. I've talked about this before, to pay dividends bills if I have to tomorrow with dividends. And so because of my horizon, I like to buy stocks that have typically a higher starting yield. They are growing the dividend, they're dividend growth stocks, but oftentimes they're not quite as fast as a company like Disney. Although I do mix and match, I mix them all up. I own a diversified portfolio, so I have exposure to both sides of the spectrum and everything in between. There's kind of like on one side of the spectrum, you got stuff like Disney. On the other side, you have stuff like regulated electric utilities, where you get a high starting yield, low dividend growth rate. Then you got stuff in the middle that are kind of consumer non-cyclicals that have a reasonable starting yield, maybe in the 3 to 3.5% range, but they're growing it a little slower. I kind of own the whole spectrum, but I probably shift more towards the utilities, more towards the consumer non-cyclical, because I want the opportunity to retire sooner than later. I need the high yield on cost now, so I go for that stuff. But look, if my time horizon were further out, if it were literally 50 years from now, maybe I would skew a little more towards companies like Disney. But really, this is a great question. It all comes down to time horizon. So my homework for you, go home, think about it. Are you like me? Do you want to start living off of dividends realistically within the next 10 years? Or maybe not fully live off of dividends, but at least pay good bills, a good amount of bills with dividends within the next 10 years? You probably will find yourself skewing more towards the types of companies I skew towards, which is everything in my stock portfolio. I'll link in the description below. You can download my portfolio. But let's say you're different than me. Maybe you're in your teenage years, maybe you're in your 20s, and I'm in my late 30s, by the way. Maybe you have a different time horizon. You are not so interested in retiring quickly, but you want to stretch it out. You're trying to prepare for your traditional retirement. You may find yourself looking at stocks more like the Disneys of the world. And so there's stocks for everyone. Dividend investing works for everyone. This is dividend investing for everyone on this channel, and it all comes down to time horizon. So I'm really thankful for this question, because I don't always talk about time horizon, but time horizon plays a big role in my personal strategy. Now, thankfully, I'll say even with my shorter term horizon, I want to retire sooner than later. My portfolio, I have done a study that basically proves it is slightly beating the S&P 500. And I'm proud about that, because I have a conservative strategy. And even with the conservative strategy, even with an analysis that's pretty conservative, because I don't include the compounding effect of reinvested dividends, I'm slightly edging against the S&P 500. Really, really happy about that. And so I'll link in the description below to that. That's part of my stock market portfolio as well. So if you download my portfolio, you'll get that analysis as well. But I have a separate video for it, so I'll link in the description below. Anyways, I want to move on now to question 2. So thank you for subscriber question 1. Really good question. So question 2. Hey, I love this one. Hey Ian, what is your opinion on Nokia stock? I think it has some great upside potential with 5G innovations, also pays a great dividend. So Nokia stock, okay. Boy, my experience with Nokia, that was one of the first cell phones I owned way back in the day. Ever since the Apple iPhone was introduced, I've exclusively purchased iPhones. It is just my thing. I'm an Apple consumer. In terms of full disclosure, long Apple, ticker symbol AAPL. Here's what it comes down to in a nutshell. I don't want to have too many stocks. I don't want to diversify too much. I like to pick the stocks that are the best in any given industry. When I look at an industry like cell phones, what is a better company, Nokia or Apple? Apple. So it's as simple as that for me. But let's get into some numbers, because this is a good question. I'm not trying to put down the person asking the question either. This is a valid question. It's a good question. Maybe this person knows something I don't. Here's how I look at it, though. Nokia is trading at $5.12 per share. Here's something, though, worth noting. A lot of the time I say I don't care about capital appreciation, but I actually do. I do, because capital appreciation is a sign of a well-managed company. Nokia was at $39 back in 2007, $55 in 2000. So this company from 2000 through 2019 has gone from $55 down to $5. That is not good. Off the bat, that tells me not for me. I mean, in the short run, if a company goes down, like 3M has, in terms of full disclosure, I'm long 3M, ticker symbol MMM, fine, I'll buy some shares. I don't care if 3M is down in the dumps for the next 5 or 10 years, I'll keep buying. But when you look at a long period, like 20 years, and it's gone down that much, that's not a good sign about the company. And so, based on Yahoo Finance, the dividend right now is 4.13%. I actually had trouble validating this, so I'm just going to take it at face value, but 4.13%. 4.13 is okay. It's not great, though. I can get a similar yield with Leggett & Platt, a stock I just reviewed here in terms of full disclosure. I'm long Leggett & Platt, ticker symbol LEG. I'll link in the description below. Anyways, why would I buy Nokia when I could just buy something a little bit more stable and that I think is going to fare better in the long run, like Leggett & Platt? I just go for something like that. But anyways, let's talk about some comparables, because I like stocks that are up and to the right in the stock chart. Again, I don't care about capital appreciation. It's more that that's a byproduct of the company doing well. In the long run, short run, I don't care. But let's talk about 2 examples. There's 2 examples I want to go after because I own these stocks and they have done pretty poorly over the long term in terms of capital appreciation. One of them is BP, one of them is Royal Dutch Shell. So BP, it's at $41.76 now. It was at $73 in 2007. It was at $53 in 2000. So basically, since 2000 to 2019, it's gone from 53 to 41. That's not good, but it's a lot better than Nokia, which went from 55 to 5. And so, but anyways, why is BP down? BP is down because of 2 reasons. One, Deepwater Horizon in, I think that was in 2010, horrible tragedy. That was a really bad thing for this company. And so that was a one-time horrible oil spill, horrible event, and was tragic on the company. The other thing is just in circa 2015, there was a lot of OPEC stuff going on with OPEC flooding the market with oil. That put these guys under a lot of pressure too, at a point where they were already really weak because of Deepwater Horizon, so it wasn't a good time for oil prices to tank. Anyways, BP is down over the 20-year period, and I just told you I like stocks that are up and to the right, stocks like Apple, for example, or 3M, or Disney, quite frankly. In terms of full disclosure, both of my kids own Disney, ticker symbol DIS. Anyways, here's the difference with BP. BP right now, the current starting yield is 5.8%. But get it, check this out. I'm not buying BP now. I don't buy it. I'd consider potentially if I had no stake in any oil company. But when I was buying BP and when I took advantage of the low share price in 2015 when OPEC flooded the market with oil, BP was down at $29.57. This was back in 2015. Basically, if I take the dividend, 61 cents a quarter, I multiply by 4, I divide by my purchase price back in 2015, which was $29.57. My yield on cost at that time for that tranche, and I bought different tranches, by the way. This is my best tranche, so it's kind of like Facebook. Everyone shares their highlight reel. I'm sharing my highlight reel here. My best purchase price on BP, I'm yielding 8.3% on cost. And so this is the difference. Nokia, I don't really foresee them as a company, hey, they're going to raise the dividend a lot in the future, or there's a lot of certainty behind their technology. BP, I'm pretty certain that they've got oil in the ground. They're going to extract it. They're going to prosper from that in the long run as long as they don't make a major mistake, a tragedy like Deepwater Horizon again, and as long as the price of oil is somewhat stable, which I think it will be, plus or minus, And so anyways, that's the difference. If I'm going to buy, and most of my stocks, by the way, are up and to the right, but if I'm going to buy a stock where it's kind of flat, if not down, I better lock in a massive yield on cost. And BP is an example of that, locking in that 8%. And so Royal Dutch Shell is similar. By the way, my favorite oil company is Chevron. In terms of full disclosure, I'm long Chevron, ticker symbol CVX. Also, in terms of full disclosure, I'm long Royal Dutch Shell, ticker symbol RDSA. Anyways, Royal Dutch Shell, let me look at this when I wrote my notes down here. 5.92% starting yield. But again, I'm not buying Royal Dutch Shell now. I bought it. Over the years, but I took opportunity to buy a really solid tranche in 2015 when OPEC was flooding the market, and I locked in a 7.8% yield on cost there. So their dividend per year, if I add up all the quarters, is $3.76. I divide by my purchase price back then of $48.45, 7.8% yield on cost. By the way, the price of Royal Dutch Shell right now, I didn't write it down. Anyways, 7.8% yield on cost. By the way, the price of Royal Dutch Shell right now, I didn't write it down. Anyways, 7.8% yield on cost. By the way, the price of Royal Dutch Shell right now, I didn't write it down. Anyways, Royal Dutch Shell is another example, though. If I look over the just long periods of time, I didn't write down the specifics here, but I look at like 2000 versus 2019, stock's not really going anywhere. It's kind of flatlined, if not slightly down. It's kind of like BP, but a little bit faring a little better than BP because they didn't have Deepwater Horizon. Now, the reason that I buy these types of companies, again, one, it's different. It's not technology. I'm dependent here on oil, which is a very valuable commodity that is used for fuel. It's used for manufacturing plastics. It's used in industry. It's used for so many things. I don't think oil is going away. And it's going to be here as our worldwide population continues to grow. And so I invest in oil companies. I don't have a huge allocation to them, but I have some allocation to them. I do this in times when there's a cyclical downturn, the price of oil is down, these stocks are doing really poorly, and I lock in a very high yield on cost. I'm talking 7%, 7.5% or more, and in this case, more. And so the way I look at a Nokia, stock's gone nowhere over the long term. I don't have a lot of visibility into their future. I think there are better companies, aka Apple, that may fare better than these guys. And I'm just not locking in a high yield on cost because I don't even think they're going to grow the dividend. The thing about BP and Royal Dutch Shell is when I bought them, I knew I was locking in a high yield on cost because I wasn't even baking in future dividend growth. In fact, Royal Dutch Shell, they haven't even grown the dividend since I bought it, but I still have that 7.8% yield on cost because I just bought low. Nokia, I'd have to make the same assumption. I'd have to assume, hey, dividend's not going to go up. And if I do that, and I'm locking in just here a... what was it again? 4.13? Just not enough for me. Just can't do it, especially in the tech space that's so risky. As it is, I don't like investing in tech because there's too many changes. The only two pure play tech companies I have are Apple, already mentioned that in terms of full disclosure, long AAPL, and IBM. In terms of full disclosure, I'm long IBM, ticker IBM. Anyways, those are my thoughts, but look, I could be wrong. I'm not the world's greatest tech investor. I am more of a bread and butter consumer, non-cyclical, easygoing dividend kind of investor, one that beats the S&P but with a little less risk taken on. And so the fact of the matter is let me know what you think about Nokia, but I did want to touch on this subscriber question. Great question. Not trying to put your stock down. Wish you the best. And I want to reiterate, there are so many strategies out there that work, but the one that works for me is dividends because I want to pay bills with dividends. And I want to do it with a lot, really minimizing my risk. That's another point on Nokia. This is the kind of company that could go under. And so for that reason, I just feel more safe owning the companies that I own. And I own 40 of them, by the way, because I diversified to mitigate risk. But that being said, I try to pick safe companies with each of them. I just don't feel that way about a stock that has gone down so much over the 20-year period, and I just don't know what their future holds. Okay, moving on to question number 3, but thank you, good questions. So this is from Brian. Hey Brian, thank you again. This one came on Facebook, but I'll just tell you something about me. I don't really enjoy using Facebook anymore. It just isn't my thing. I have a Facebook account, I use it, but I'm glad Facebook acquired Instagram because I love Instagram. I use that daily. I love Twitter as well. And so for me, if you catch me on YouTube, Instagram or Twitter, you're going to get me. You're going to really get me. You're going to captivate my attention. But on Facebook, I apologize actually for the folks reaching out. I just don't monitor it quite as close just because it's not as fun and exciting for me for whatever reason to engage with that platform. But I love Instagram, and all of that good karma and good vibes goes back to Facebook because they own Instagram. Anyways, my friend Brian asked a question on Facebook, and Brian is one of my oldest subscribers, so thank you, Brian, to you and your wife. You guys are the best. We love you guys. Thank you. Anyways, he asked an interesting question, and I'm sure a lot of you are kind of thinking about this. One, I'm going to address this. One person even said I had a lot of ad breaks on my last video. I'll tell you something. I don't sell a course here as of this time. I'm putting all of my best content for free on YouTube, and so I'll just leave it at that to address that person's question, but or that person's comment. But here's Brian's question. You're awesome, Ian. Love what you do for the community. Thank you. I love the community myself. This is an amazing community, and I'm blessed to be part of it. Everyone here, all we're up to 27,000 of us now. My wife and I wondered, you ever took your ad revenue and invested in a dividend stock? So he's talking about ad revenue from my YouTube channel. And so that's a really good question. I actually think I have used my ad revenue in the past to buy stocks here and there, but I'll tell you something. My advertising revenue that I receive here on PPC Ian, it's not a tremendous amount of ad revenue. In fact, some of the other YouTubers out there, they actually share, hey, here's how much I'm earning on YouTube. And I look at their numbers, and a lot of these guys, they have less views, less subscribers than me, fewer subscribers, and their numbers are like through the roof. They're way bigger than mine. And so they must be doing something that I'm not. They may have a different target audience. They may have a different community than we have here. But needless to say, I am blessed. I do receive some ad revenue. And it's nowhere in the ballpark to what a lot of these other YouTubers receive, but I am fine with that, and I love what I do here, and I am learning so much as I contribute to the community. We have built something really special here, and quite frankly, I am excited to be rewarded with ad revenue as well. But again, it's not so tremendous like a lot of these other YouTube channels, but hopefully it'll continue to grow over time, because that allows me to invest more into this channel. It allows me to have more equipment. It allows me to place more of my time into this channel, which is something I really want to do. Anyways, in the last bit, I'll actually tell you most of my ad revenue has gone to my new logo and that new animation at the beginning of the videos. I hope you guys love that. I'm so proud of the logo. Some of you already commented on that. Thank you so much. And it's also just gone to some other back office stuff related to running the channel. I've been making some upgrades to my website, for example, as well. I'm trying to actually prep my website to be something that I can use a little bit more, because I am writing my book, and at some point I want to be able to market my book online. I want to share my book with the world. And I can only do that if I have a really functional, up-to-date website. And so I'm going through some of that back office work right now, and that takes time and money to do some of that stuff, to make those upgrades to my website that is honestly a little bit old and outdated. But I'm really proud of it now, because finally it actually reflects not digital marketing, which is what it used to, but dividend investing, which is what I am sharing with the world on this YouTube channel. And so anyways, that's where a lot of the ad revenue goes, and sometimes I've actually used it in the past here and there to pay a bill or two. So the way I look at YouTube, I'll tell you, I'll be honest with all of you, I look at it as another stream of revenue. Now, is that the only reason that I am doing this? Absolutely not. But in life, I believe it is important for work. I consider actually this channel part of my work. This is a job to me. This is work. And there's nothing more exciting in this world than to have work that you are excited to get up and do every morning. You love. It is your passion. And that's what this is to me. This is a passion. This is work. And oftentimes it's hard work. And when I do work, I do want to be rewarded with some income for that work. But I'll tell you, it's funny. The income I receive here, even though it's not huge, I kind of value it like 100 to 1. Like if I were to go out, take like a consulting job and do some consulting work. I get these offers all the time. Ian, help me with my digital marketing, for example, or do some help me out in the health insurance space. You have some expertise in health insurance, do some consulting. And I do that stuff from time to time. What I'm saying is if I can earn $1 here, I value that as the same as $100 earned out there. It's kind of like a 100 to 1 ratio, and it comes down to passion and purpose, and that's what this channel is to me. I love it. It is so important to me, and it is one of the reasons I get up in the morning. I'm so excited to work on it, and a lot of that is because of all of you guys, the community, and I'm so grateful. I cannot say thank you to all of you guys enough for what you have contributed here in terms of the comments, the subscriptions, the likes. All of that really means the world to me. And so that's it. That's my answer. And now I hope my YouTube revenue, my ad revenue, it continues to grow over time. And as I receive that ad revenue, I will continue to use it to reinvest into the channel, hopefully at some point to buy some more dividend stocks, to pay bills, all kinds of stuff, just as I would the income that would come from a business or a job. I have a consulting company, I have a job, kind of look at the income from those the same. And so the thing though I want to say that I love about YouTube is multiple streams of income. I have multiple streams of income. I have it from dividend stocks, I have it from YouTube, I have it from my job, I have it from consulting projects, so I've got some streams of revenue, which I am blessed. And I'll tell you, the one thing worth mentioning, this is not passive income. A lot of people say, hey, build a website or a YouTube channel, it's passive income. No, it's very active, it's more active. I have to value my income here 100 to 1, because if I didn't, economically, it would not make sense. It has to be something I'm passionate about, because for a time invested basis, just the trade-offs, it's just not there the way it is with a job. But again, it comes down to passion. So it's very, very active income, not passive income at all, but I'm blessed to have it. I really love you guys, and I truly value it. And at this point, by the way, I do not have any intention in any time soon or to create a course. I continue to share all of my best content here on YouTube for free. Now, on the topic of gratitude, I was going to post something on Twitter, but I just want to share it here. I went on a run yesterday, and I know I got a lot of runners in the community. Awesome. It's such a good sport. And I like long distance running. And I'll tell you, when I went yesterday, I went in the morning, and I just made a habit recently of saying thank you. I just literally, I'm running, sometimes in my mind, but mostly out loud, I'll say thank you, and I'll say it sometimes thank you, and then I'll say it louder, like thank you. Sometimes I'll shout, I'll be like thank you. And some people probably think I'm crazy, that's all good, but what happens is every time I say thank you, I get a burst of energy. So if you, just a tip for you guys, I guess tip number 4 today, I guess the first 3 are questions, this is more a tip, but go out there, and if you are a runner and you want a burst of energy, maybe you're just in a race or you're running on your own, try it out. Try the thank you run. And what's great is you get home, you feel a lot of gratitude, and we all know that gratitude really takes us all to the next level. It's what elevates us as humans, as business people, as leaders. And so I've been trying to practice more gratitude. I have a lot of work to do. There's certain times of the day I found like mornings are kind of more challenging for me. I wake up, I'm tired, I don't feel as thankful. And so I'm trying to continually improve, and one of the ways I've done that is through the thank you run. So just a fun side tip, a side note about me, about my personal life. And so in terms of full disclosure, I already disclosed all the stocks today. There's too many for me to disclose now, so that's why I did it through the video. The stocks I disclosed in today's video, I own all the stocks, and the Disney one my kids own, so I disclosed all that. In terms of a disclaimer, today's video is not investment advice. I'm not a licensed investment advisor. Today's video is just for your fun and entertainment. If you're going to go out and invest in the stock market or anywhere else, please consult a licensed financial advisor first. Literally just sharing my journey here on YouTube for fun and entertainment. All right, everyone. We're up to 20 questions answered now, so I got 5 more to go, and by the time I answer those 5, we'll be at 30,000 subscribers. So we got a lot of questions, so please, a lot of questions to answer, so please keep them coming in. I will see you all in the next dividend investing video.